Hello, everyone. This is Caroline with CRP Specialists. I wanted to tell you a few things that I learned along the way from beginning my business. As some of you probably don't know, this is not my first time beginning a business. This is actually my second opportunity having begun a business. I had a business back in the late 90s, early 2000s, and I had to shut down due to life circumstances. So it is my second opportunity having started a business. So I definitely have a few things that I've learned along the way. So, a couple of things for bookkeepers, because obviously that is my industry, so I know more about it than any other things. I'm not touching on actual business things, I'm talking on bookkeeping things that I want to share with other bookkeepers. So, something I actually talk about to many people that I have mentored along the way. One thing very, very strongly I suggest is keep it simple. Don't overcomplicate your books, because, this is really something that I hear from a lot of people when they're doing their other people's books. They get things, they really overcomplicate their thinking, and if just keep it simple. Don't overcomplicate their thinking, and just when you're looking at the books and you see something that really is confusing, try and break it down and keep it simple. So that's really number one thing. Um, don't Please don't record depreciation. That is another thing. Let the CPAs do the work. This is not something that we as bookkeepers need to do. The CPAs are the ones that do the depreciation and the recording, or not the recording, but we do the recording of it. They provide us that information. So, um, if there's a journal entry that you've entered for depreciation, please reverse that journal entry. Unless it's been provided to you by a CPA, reverse that journal entry. That is not something that we as bookkeepers should ever be doing and making that determination. That is something that a CPA should be giving to us as a journal entry to do at year end, or if you're conversing with a CPA, they're providing that information for us, maybe quarterly, whatever the case may be. But that is not something as us as bookkeepers, we make that determination. Um, don't ever, please, um, enter anything as a miscellaneous expense. Miscellaneous expenses do not exist. Um, Generally, those things are considered either office expenses or office supplies. If you pick that, it avoids any kind of questions along the lines. You should, if there's something that you would be classifying as a miscellaneous expense, ask your client, because that's really where that stands. You're going to get an answer from your client about what that miscellaneous expense should be. Uh, Reconcile at year end. You really want to reconcile all of those accounts, your bank accounts, your credit cards, through the end of January before you turn all of your accounts in for tax preparation. This gives your tax preparer a better answer for everything for year end. You're going to have all of your accounts reconciled through to at the end of January. Um, Obviously, that's not something that generally is an issue, because you don't get, they don't generally get any of their 1099s or W-2s or anything by until the end of January anyways, and they're not going to turn over any of their tax information generally until the end of January. I mean, unless they're a SCorp, which then their fiscal year runs different times, and that doesn't really pertain to them. But your LLCs, your SCorps, they're all generally going to be running at fiscal or their year end, so by the end of January. So you need to make sure that you're doing all of that reconciliation by January 31st, and then turning over the documents for the year end to the CPA, tax preparer, whatever the case may be. So, but all the reconciliations January 31st. Now, for SCorps, this is something I kind of learned along the way. Make sure that your balance sheet for the prior year end matches the tax return balance for the same. So it helps you understand, well, I mean, if they had a prior year balance, obviously. If this is their first year, that's not going to happen. But if your prior year balance, your prior year end matches the tax return, then you know you're in a good place. You know that your starting balance is going to be correct. I hope that makes sense. So now this next one is probably one of the biggest errors I see being made. And that is that if a client makes an office supply or expense greater than $2,500. So be sure that you get details and that there's something provided in the memo section, because this is you need to describe the asset, or whether it's a down payment or whether it's the full cost of the item. This is because this is going to be differentiating that expense, whether it's tools, whatever the case may be, because this is going to be something that needs to be separated out so that they know whether it's going to have to be capitalized or if it's going to be just, for the de minimis $2,500 election. But these are things that you need to make sure they're documented, most especially. Sometimes it's good to separate out to have a capitalized account, one for the account that says, purchases above 2,500 and purchases below 2,500, just for the sake of making sure that you're not going to categorize these things into the wrong account. Now, just makes things easier when you're categorizing the expenses. What else? One of the things that people often think or say is that this is a reimbursable expense. In reality, there really is no such thing as a reimbursable expense. If they purchase something like office supplies with personal funds and the owner is really asking to be reimbursed, it gets recorded as office supplies. Simple as that. Yeah, it is technically reimbursed, but it's still being recorded as office supplies. It is still considered office supplies. It's still expensed as an office supply. Does that make sense? I don't know if that, just so you're understanding, it is still considered an office supply, regardless. So that's why it's not technically considered a reimbursable expense. So I know that people get really, really hung up on that reimbursable expense category, technical jargon. And I think really those are probably the main things. And probably one of the other things, my last is when it comes to an SCorp, as far as mileage, as far as an SCorp, the members for an SCorp can't really be, they are, I'm trying to explain it so that it makes sense here. So if an owner or employee is reimbursed for travel or mileage, it gets recorded as reimbursed for mileage. But a schedule, if that gets put on the Schedule C, it's not reimbursed for mileage. SCorp members or shareholders may be reimbursed, though, only if it's on the accountable plan. They have to have an actual accountable plan in place. So that's where it kind of gets a little bit confused. So, or accountability plan. So SCorps must have an accountability plan in place for that mileage to be reimbursed. So that's one of the things I think that people get a little bit confused if they don't have those accountability plans in place. But when it comes to an LLC or an individual person, that owner can definitely is not generally reimbursed for mileage. They have to put it's done individually on their individual tax returns. That's the difference. It doesn't get done on their person. It's not done on the business. So it's kind of an odd little balance, and that's where that's kind of a misunderstanding. So um, I think that's about all I had as far as the things I wanted to make sure that you guys, kind of the things I picked up along the lines, along the way. I hope this is helpful. Um, Again, if there's anything that you guys need, please, I would love it if you guys joined me in my Bookkeeping is Fun group. We are sharing a lot of information in the group as we progress. And these are the things that we've been working on as we, day by day, little by little, we're helping each other. We're learning from each other. And I hope to see you there. And I hope you have a wonderful day.